And good morning once again, options traders. I hope everybody had a fabulous Thanksgiving and getting ready to get back into trading. Today I've got a long question for you, but a very important one. And that is, are short strangles on volatile stocks safer than short straddles on low volatility stocks? And this is a question that comes up a lot, especially during all of the market turmoil that we've had. We get into some periods of high volatility, and so traders will start shorting options trying to capture this high time decay. And to try to make things safer, a lot of times they will turn to strangles, try to widen out those break-even points. And that's what we're trying to ask here. Is that really going to make things safer? Well, let's go have a look. And as always, before we do, please be sure to click like and subscribe. It goes a long way into promoting the channel and is very much appreciated. So, quick review. Straddle. Remember, it's a strategy where you're going to buy a call, buy a put, but you have the same strike and expiration. So maybe you buy the ABC August $100 call for $5.50, and you buy the corresponding $100 put for $4.50. We would say that you are long the ABC $100 straddle for $10. That's just the two prices that you paid, and therefore the maximum loss is 10. This would be your risk graph. As always, I'd like to point out that we get a bend at the strike because both options are a 100 strike. We only have one bend in the graph. So the black curve is the expiration graph, the red curve is the current. And so as time passes, that red curve starts to dip down and will eventually become the black. But the one thing that is a drawback to a long straddle is the break-evens. We have to find the upper break-even by taking the strike plus the premium, in this case 10 bucks. And the lower break even by taking the strike minus the premium. So let's do that. Let's take the $100 strike minus the $10 premium. That gives us a lower break even of 90. We take the 100 strike plus the $10 premium, gives us an upper break even of 110. But this is the big problem for straddle traders, this very wide range of losses. So to trade a straddle, you're either looking for an explosive move to the upside to get out here into profitability, or an explosive move to the downside to get out here. So that's the straddle, and because of these wide break-evens, this is where people think, hey, let me flip it, let me be the short side, because then I've got a very high probability for success. And then they think, well, why use straddles when we can use a strangle? The strangle and the straddle are similar ideas. Sometimes you'll hear the strangle called a sister strategy. The difference is that you will use different strikes. So for instance, maybe you buy the August 95 put and you buy the August 105 call. You would have the long 95 105 strangle. And again, it widens out the strikes because you've got a lower strike put and a higher strike call. And all things being equal, it means that's going to be cheaper. So if we compare these two risk graphs, there they are. You can see that we have wider break-even points on the strangle in red, but it's also cheaper. We don't have the same maximum loss that we do for a straddle. So again, this is where traders look at these strategies and say, yeah, they're very high risk, very low chance that you're going to get out here into profitability. Well, what if we short them? If we do that, we're going to have a very wide range of potential profits. So here's the same two strategies. In black, we have the straddle. In red, we have the strangle. But now look at this. These super wide break-even points become an apparent benefit. It's going to be much harder for that stock, assuming it's right here at 100, to get way out here to the right or way down here to the left. And so that's what leads traders to believe this is an ideal strategy in higher volatility environments. Now, of course, if you widen out the strikes even more, maybe go to the 9110 strangle, you're going to go from this in red to this. You're going to make it even wider and give it an apparently even bigger benefit. But when you do that, of course, the options get cheaper. And this is starting to set up one of the risks. So before we check that out, let's take a look at a couple of stocks. And we've seen these before, but it's a really important point. So the question is, which has more risk? Let's take a look at Gilead Sciences, biotech company, and Ford Motors. Now, Gilead, at the time when I shot these screenshots, this is in E-Trade. So here is the information. It's a little hard to see, so I've just reprinted it up here. We have a current implied volatility of about 18% and a 52-week historic volatility ranging between 14 and 41%. So that's for Gilead. Let's go do the same thing for Ford. We get 15.5% current implied volatility for Ford. We get 12 to 47% for the 52-week historic volatility. So for comparison, over here on the left is Gilead. Now take a look. We've got 18% for Gilead, 15.5% for Ford, pretty close. For the 52-week range, 14 to 41% for Gilead, 12 to 47% for Ford. Again, pretty close. And so this is where traders will assume that these two stocks are about equally risky. And so they'll turn to the one that might have the bigger premiums on it. But that misses the point. It is not about the strategy that has the wider break-evens. That's not what's making it safer. It's this. We have to look at the daily changes in terms of standard deviations in both of these stocks. So let's take a look at Gilead. We have 252 bars. This is for each trading day during that year. And so what this means, let's take a look at this big one right here. On this day, that one-day price change was 3.5 standard deviations up. Big price change. But the thing that you want to look at is, for the most part, we hit plus and minus 3. Plus 3 was about the largest, minus 3 was about the smallest. We got about 68% of the data within plus and minus 1 standard deviation. Exactly what you would expect. So this is what we call a well-behaved distribution. It just means that it really conforms nicely to a bell curve. And if we were to graph this into a histogram, this is what we would get. Again, pretty close to a bell curve. And that means, all things being equal, it's relatively safe because we can make good decisions because our probabilities are reasonably known. But now let's go and do the same thing for Ford. Very different looking picture. Take a look at this bar right here. That would be expected to occur once every 1.4 million years. Check these two out on the bookends out here. Once every billion years. And yet we got two of those in the same year. See, this is not conforming to a bell curve. And it's these potential tails out here that can absolutely get you killed. Here's what this information looks like in a bell curve. Take a look at these tails. I mean, you've got some serious potential risks, even though you might think you've got very low risk with a strangle. Now, there's another potential problem that we've talked about before in previous videos, but it certainly deserves a spot here for this one, and that is Normalized Vega. Remember what this is. It is Vega divided by the options price. And what it does, it shows the percentage change in an options price for a one-tick move in volatility. A one-tick move just simply means that you're moving from, let's say, 20% to 21%, or from 20% down to 19%. So let's take a look at an at-the-money option. Let's say we've got a $100 call trading for $232 with volatility of 20%. Pricing model might show that the Vega is 0.11. And what that means is that if volatility increases right now from 20% to 21%, that $100 call is going to pick up Vega, or 11 cents. Its price is going to rise to $2.43. So how big is that in percentage terms? Well, it's the 11 cents, the Vega, divided by the option's initial price, 4.7%. So it's not super sensitive to changes in volatility, and partly because this is an at-the-money option. But wait a minute, everybody says that an at-the-money option has the greatest sensitivity to Vega. Well, that's a little bit of a misperception. It has the largest value, what's called an absolute value, but it's not the riskiest in terms of percents. For those, you have to look at the out-of-the-money options. So yes, at-the-money options have the largest Vega in terms of an absolute number, but the out-of-the-money options have the largest normalized Vega. They have the largest percentage changes, and percentages are a bigger risk when you're talking about losses. So let's take a look at what happens with doubling volatility. You get into a volatile market and volatility doubles, let's say, from 30 to 60%. Well, if volatility doubles, an at-the-money options price doubles. However, out-of-the-money options go up multiple times more, many multiples. And so as volatility rises, traders are tempted to sell further and further out of the money options, which only makes the trade potentially riskier. And that's exactly what happens when they're selling these way out of the money options with these short strangles. So to make things an even bigger risk, traders often sell more out of the money contracts to receive the same dollar value. And when they do that, risk rises exponentially. So let's take a look at an example. Let's say that the stock is 200 and I've got 30 days to expiration and 30% volatility, interest rates of 1%. All of these options that I'm showing here are puts. You're going to get very similar characteristics for the calls. But the at-the-money put is priced at 678 and has a Vega of almost 23. But the normalized Vega is only a little over 3%. That's just saying that a Vega of about 22, 23 cents isn't all that big compared to an options price of $6.78. But look what happens when we start going out of the money to lower strike puts. Look at this one way down here, the 160 strike. Yeah, it's only selling for 2 cents. And yeah, the Vega's smaller. 0.0069 is certainly much smaller than 0.2284. See, that's what's meant when we say that at-the-money options have a larger Vega. But let's take a look at them in percentage terms. These out-of-the-money options, the 160 strikes, have a normalized Vega of 31%. So here's the problem that people run into when they start selling these short strangles, trying to move these strikes further and further out of the money. Let's take a look at the 170 strike as an example, priced at about 18 cents. And so what they'll say is, well, it's only $18, but if I do it 10 times, that's $180. Or if I do it 20 times, that's $360. So let me put this thing on in large quantities so I can make my car payment or my rent payment or whatever. And so they just pile on the contracts thinking that they're super safe. Well, let's see what happens to this 170 strike if volatility doubles. So our pricing model says the stock is 200, we have the 170 strike, but we double volatility to 60%. Now the puts price is 290. Remember, it was 18 cents. So look at that. If you have to buy these things back for 290, that's over 1,500% of an increase. I told you they were exponentially larger. This could put you in a world of hurt, even though volatility did a modest doubling. Now, what happens if we get this doubling and the stock drops? Let's leave volatility at 60%, but let's bring the price down to 175. Notice it's still an out-of-the-money put. But by this time, you've got such a massive maintenance call, the broker's going to be shutting you down. Those puts are trading for $9.44. So $9.44 relative to your 18-cent selling price is over a 5,000% increase. This is where people get hurt. So the main thing to take from all of this is it's not about the strategy and which one has the wider break-even points. That's not the question. So the question is, when you're thinking of shorting these calls and puts, which is what you're doing with straddles and strangles on the short side, is not how likely it is for these to go in the money. The question is, what is the nature of these distributions? Are they well behaved or are they very poorly behaved, such as this one? And that's the bigger issue, not which strategy has the wider break-evens. And so for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.